Welcome to the Deep Dive. Today we're taking a magnifying glass to, well, two things that seem really complicated.
They really are.
On one hand, you have the foundational rules of U.S. financial systems, and on the other, the very personal journey of building financial stability when you're brand new to the country.
And it's a crucial deep dive for you, the listener, because we're tackling confusion on two fronts. First, there's the abstract, almost nonsensical language of accounting.
Where words mean the opposite of what you'd think.
Exactly. And second, the very real, complex, systemic barriers that make it so hard for new Americans to get a foothold.
So what's our mission here?
Our mission is to connect those two threads. We want to show that understanding the underlying structure of the system is really the best defense against being exploited by it.
Okay, so let's start with that theoretical confusion, the one that trips up, almost everyone.
Right.
We're all conditioned to believe that if you see a debit, money is going away.
And credit means money is coming in.
It seems so simple, but that's a lie, isn't it?
It is the great lie of introductory finance. Your bank statement operates on everyday English, but the actual accounting system that operates on position.
Position.
Yeah, think of the core rule double entry bookkeeping as a non-negotiable balance beam.
Right.
Or maybe a giant capital T account.
The T account, the backbone of every ledger.
Exactly. The rule is purely positional. Debits are always entered on the left.
And credits are always on the right.
Always on the right. And in every single transaction, the total debited has to equal the total credited.
It must always balance.
Always.
So, okay, whether a debit means add or subtract has nothing to do with the word itself.
No.
It's all about which type of account you're looking at.
Precisely. We categorize every financial element into one of 5 types: assets, liabilities, equity, revenue, or expense. And this is where it gets really confusing for people.
Could give us the breakdown. What increases with a debit and what increases with a credit?
Let's start with assets and expenses. They go together. If your business gains an asset, let's say cash, you debit that account. If you have an expense, you debit that expense account. So for assets and expenses, a debit means increase.
A debit is a plus.
Got it. Now for liabilities, equity, and revenue, the LER accounts, it's the opposite. A credit means increase.
So if a company takes on debt, that's a liability.
And you credit the account to show it went up.
So if I use my own money, which is an asset, to pay a business expense, I'm debiting the expense account.
To increase it, yep.
And crediting my cash asset account.
To decrease it, the money moves and the T account is still perfectly balanced.
Okay, I think I'm following.
But here is the massive kicker. The thing that causes all the confusion, even for CPAs, it's how your bank applies this to your personal checking account.
This is where it all falls apart.
Yeah.
Because when I deposit cash, my balance goes up, and my bank calls that a credit.
Right, but why?
I have no idea.
When you put $500 into your checking account, that money is technically a liability for the bank.
A liability.
They owe you that money back. And we
Right.
just said that liabilities increase with a credit.
Oh, wow. So when my bank gives me a credit, they're just noting that their liability to me went up.
You've got it.
So wait, the debit card, which we use to make our balance go down,
Mm-hmm.
is it called that because it tells the bank to debit its liability account to reduce what it owes me?
Not even. It's even more mixed up. When you swipe your debit card, you are reducing your asset, your cash. And asset reduction in accounting terms is a credit.
So it should be a credit card.
But they named the plastic a debit card. The terms are so misused in consumer banking that they actively conflict with the actual rules of accounting. The system is confusing from the jump.
That structural confusion is just the baseline. Now let's pivot from the abstract rules of the ledger.
Right.
The very real barriers people face when they're new to the U.S. The biggest one seems to be this thing called credit invisibility.
Credit invisibility is a massive silent hurdle. It just means you don't have a credit record with the 3 big bureaus, Experian, Equifax, or TransUnion.
So they can't generate a score for you.
Exactly. And the numbers are striking. We're talking about 45 million Americans.
45 million.
And the data shows certain communities are hit way harder. Latinos, for example, are nearly twice as likely to be credit invisible compared to whites.
And this is such a critical point. Someone could have had a perfect credit history in, I don't know, Canada or Korea for 20 years.
Doesn't matter.
And that history just vanishes when they get here.
Right.
Why? Is there no system for that?
Unfortunately, no. There's no robust mechanism for that. The U.S. system is very siloed. Most lenders and scoring models like FICO, they need a U.S. credit file to even exist.
How long does that take?
Typically, you need at least 1 to 6 months of reported payment history linked to a U.S. ID number before a score can even be calculated,
And without that, you're just seen as high risk.
which is profoundly expensive.
And expensive how? I mean, it's not just about getting a mortgage or a car loan, is it?
Oh, absolutely not. It affects everything. Renting an apartment means a bigger security deposit. Utility companies want larger deposits just to turn on the lights.
Even a cell phone plan.
Even getting a cell phone plan without a huge prepayment can be tough. It's a cycle where being financially invisible means you pay more for everything, which makes it harder to save.
So to even start building that history, you need some key identification. What are the essentials?
There are 2 crucial numbers. The standard one is the Social Security number, or SSN,
Okay.
which you usually need work authorization or legal student status to get. But if someone isn't eligible for an SSN, the individual taxpayer identification number,
The ITN.
the ITIN, that becomes absolutely essential.
The ITN is from the IRS for taxes, but it does more than that.
So much more. It lets people fulfill tax obligations, of course. But for financial inclusion, it's huge. Many banks allow ITN holders to open interest-bearing accounts, apply for loans.
And crucially, start building that U.S. credit history.
Exactly.
So getting the ID is step 1. Step 2 is a bank account. What do the sources say is the best place to start for someone with an ITN?
Well, they need formal banking just to track payments and avoid those awful check cashing fees.
Sure. With proper ID, an SSN, ITIN, even a consular ID or passport, they can open an account. And the sources consistently point to credit unions as being the best resource.
Why them specifically?
They're community-focused, they're nonprofits, and they often have more flexible rules and a better track record of serving ITIN holders than the big commercial banks do.
That recommendation for credit unions really highlights a bigger problem, though. The system is often set up against these communities.
It is.
Let's talk about the financial burden of just adjusting your immigration status. That often seems to be a fast track right into debt.
The costs are staggering, and they're almost always underestimated. Visa fees alone can be anywhere from, say, $500 to $6,000.
And that's before lawyers.
That's before legal help, which adds thousands more.
We saw an incredible statistic about the cost of citizenship itself.
Yeah, the cost of the naturalization application, the N-400, it shows a clear systemic barrier.
Yeah.
Since 1995, that fee has gone up by a colossal 545%.
545%. Wow. It went from $95 to the current $640, plus an $85 biometric fee. And even with fee waiver programs, the exclusion is profound.
How profound.
It's extremely significant. The data shows that even with waivers, 55% of eligible lawful permanent residents, LPRs, are still priced out of the process.
And an LPR is someone who's already authorized to live and work here permanently.
Right. By pricing them out of citizenship, you're blocking them from the greater stability and job mobility that status provides.
So this high cost, combined with how traditional banks behave,
Yeah,
it creates a kind of market failure.
it does. Banks often view low-income and new immigrant communities as unprofitable. Smaller account balances, perceived higher risk.
And that leads to banking deserts.
Exactly. The systemic absence of bank branches. This isn't just something that happens. It's a failure of the traditional financial system.
And when traditional banks pull out, something else rushes in to fill that void.
And it's often with disastrous consequences. These alternative services are very smart. They're often culturally competent. They're convenient. They set up shop in high-traffic, low-income areas where the need is greatest.
But that convenience comes at a ridiculous cost.
An astronomical cost. We're talking about payday lenders and check cashers.
With triple-digit interest rates.
Correct. A typical payday loan can have an APR of up to 391%.
391%.
Just think about that. You borrow a few $100s to cover a fee, you could end up paying back 4 times that in interest alone. And we see this on the map.
Right.
One Long Beach neighborhood, 51% Latinx, had 65% of the city's predatory lenders.
And how many banks?
Only 30% of its traditional banks. That contrast it highlights the deliberate targeting.
And those high rates are what lead to the debt trap everyone talks about.
It's called debt churning. It's where the borrower has to take out a new loan just to pay off the first one. They can't cover the principal plus that 391% interest.
So they're just rolling debt over and over.
And the sources are clear. A huge majority, 76% of payday loans, result in this churning process. It traps borrowers in these severe escalating debt cycles that are almost impossible to break out of.
So the challenge is acute. People need credit to get by, but they need safe ways to build it.
And avoid that debt churn.
Let's shift to the actionable, responsible ways to build a credit profile. When you talk about credit scores, what's the #1 factor?
Payment history, period. It accounts for 35% of your FICO score. The name of the game is consistency. You need a long, reliable history of paying your debts on time.
So for someone starting from zero, the secured credit card is usually seen as the best first step. How does that work?
A secured card is ideal because it minimizes the risk for the lender. You have to give them a refundable security deposit.
Like a down payment?
Kind of. It's often between, say, $49 and maybe $2,500. And that deposit usually becomes your credit limit. By using that card responsibly, keeping the balance low, making those on-time payments, all that activity gets reported. And after 6 or 7 months of good behavior, many lenders will graduate you to a regular unsecured card and give you your deposit back.
That's a great tool, but you need to have that initial deposit money. What if someone can't afford that, say, $200 or $500 lump sum?
That's where some innovative tools come in, like credit builder loans and lending circles.
A credit builder loan, how's that different?
It basically works in reverse. You don't get the loan money up front. Instead, the money, say, $500 or $1,000, is held in a locked savings account for you.
While you make payments on it.
Exactly. You make monthly payments toward it, and once the loan term is done, the money is released to you.
So you're basically paying off a loan to yourself, but the lender is reporting those payments to the credit bureaus.
Precisely. It's risk-free credit building. And lending circles, like the ones from Mission Asset Fund, take that idea to a community level. A group of people pools money, they take turns receiving the pot, and all that payment activity gets reported. It uses social accountability.
We also saw that technology is starting to help bridge this gap, especially by looking beyond just the FICO score.
Yeah, the use of alternative data is a huge step. Some lenders are looking at creditworthiness using data that FICO usually ignores, like on-time rent, utility, and cell phone payments.
Which gives a huge advantage to people who are already being responsible but are just invisible to the system.
Right. And a big player here is Experian Boost.
What's that?
It's a free service. It lets you add your on-time payments for things like utilities, rent, even streaming services directly to your Experian credit report. It's a really easy way to maybe improve your score using behavior you're already demonstrating.
Finally, we saw tools designed to streamline the whole process, to connect people with safe lenders instead of leaving them vulnerable.
That's where you see integration solutions and organizations like CDFIs coming in.
TDFI.
Community Development Financial Institution. They're mission-driven organizations built to serve economically distressed communities. So tools like Fuente Credito, they act like a digital marketplace, connecting applicants directly with vetted, affordable lenders like these credit unions and CDFIs.
Making it all online.
Right. You can upload documents, get a decision online. It cuts down on the complexity, the multiple trips, the costs. It just makes safe, affordable credit much more accessible. What really stands out when you look at all of this is that financial success, whether you're dealing with abstract accounting or building a FICO score, it all hinges on understanding that these are rules-based systems.
Oh, not random.
They're not random. Knowing that assets increase with a debit, knowing why your bank sees your deposit as a credit, these are foundational pieces of knowledge. They arm you against financial vulnerability, especially when you're establishing new roots here.
So what does this all mean for you? We've laid out a clear market failure. Where traditional banks avoid certain neighborhoods, predatory lenders with 391% APRs move in, trapping people in debt. That's not a consumer literacy failure. That is a systemic failure of access and equity. This raises a pretty important question for you, the listener, to consider. Given the extreme cost of citizenship and the clear link between a lack of mainstream banking and a saturation of high-cost lenders, what major structural policy changes, beyond just educating people about how a secured card works, should policymakers prioritize to ensure real financial equity and stability for all communities trying to build their foundation?